Let's start by defining what exactly a financial model is. To me, a financial model is a set of financial inputs that result in a set of financial outputs. Now, you may hear other terms for financial models like a forecast or a pro forma or a budget or a plan. To me, these all really mean the same thing, and they typically are prepared for any of these three reasons. Reason number one, some sort of M&A activity. Now that may be a fundraise, or maybe you're getting ready to acquire a company, or maybe you're getting ready to sell a company and you want to show the projections into the future. Reason number two is a company may have just raised capital and they need to now report to their board of directors. So this can not only be for board reporting, but it could also be for management reporting. But management reporting ties into our third reason, which is also my favorite, and that is to draw better insights into what exactly is happening in your business. Now, there are a lot of misconceptions that you may find when working with financial models, and I want to quickly dispel each of those. First myth, all financial models should include all three statements. Now, for small businesses and startups, I believe that indeed you should include all three financial statements: your income statement, your balance sheet, and your statement of cash flows. But in reality, some businesses are so large that it's really not feasible to have all this information consolidated in one file. Instead, you may have one person who's handling just the revenue forecasting, one person who's maybe analyzing information related to headcount, and different areas as such. Now, in this course, we're going to be going over three-statement modeling, which I find is going to be super valuable for your career, regardless of what organization you're actually a part of. The next myth is that once you build a financial model, your work is done. To me, this is actually when the work begins. See, your financial models should be always referred to each and every single month as you actualize your information. And you should constantly be vetting your assumptions to understand which are valid and have stood the test of time and which need a refresh. When I build a financial model, what I'll typically do is I'll get sign off by either management or the board of directors, and then I'll save down a memorialized version of that financial model so that each month when I actualize the rolling version of the financial model, I can compare against that memorialized version to see how well we're doing. If I see some really large variances, I'll want to understand what happened. And in the event that we decide that we need to come up with a new plan, well, we'll go through that same process that we went through in building the financial model initially and save down a new version, which will then allow us to compare against that newer version. I find that companies typically create a new version of their forecast around once a quarter. But once again, it depends on the size of the company. Next myth. You don't need to know anything about accounting in order to be really good at financial modeling. This is kind of true. You certainly don't need a CPA license in order to prepare a robust financial model. In fact, many people have a background in finance, they may be a CFA, or they may have an MBA and get by just fine. But if you understand some of the basics and fundamentals of accounting, you'll be able to really do so much more with your financial models. That's because accounting is the language of business. And when you understand the fundamentals of accounting, you'll understand how certain accounts must be affected when other accounts are affected, which we'll see soon when we do our deep dive on the financial statements. And how about this next myth? You should be the only one creating your financial model. Now, you may have the most amount of insight and have the most amount of knowledge into how to prepare a financial model, but the best financial models are built collaboratively. That means working with the CEO, the management and leadership team, department heads, and anyone else who has visibility into what's happening financially in the business and where the business is going to. Lastly, financial models are only about projections. Yes, projections are a really important part of a financial model, but so are the historicals. So is where the company has been. And a lot of your projections should be based relatively on what the company has been through. Now, I get it. You may want to 10x your company next month, and I encourage you to do that. But odds are there's going to be a gradual change from the way things have been with your financial performance to where the company is going. And as you'll see, when we eventually get to topics related to balance sheet forecasting, you'll actually need to have historical information from the business in order to have a starting point in order to get to where the business is going. And now that we went through some of those common myths and best practices with financial models, let's begin our deep dive on the financial statements.